You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. I thought I would do a series on myths because there are plenty of those. And so this one that I wanted to start off with is infinite banking is only for the wealthy. Well, it may certainly seem that way, as many affluent people do take advantage of the tax benefits and guaranteed growth of whole life. In fact, there's a few phrases I would like to share from a Tony Robbins book that I often will point out and share with people. The book is called Money, Master the Game. And so I'm just going to pull that up and read those quotes that I often share. First of all, the fact that this chapter, what he calls it, is secrets of the ultra wealthy that you can use too. And he's talking about what he calls the rich man's Roth, which is really exactly what we're doing, using whole life insurance, funding it heavily, and running money through it. And so he says, why in the world would a billionaire buy life insurance? Won't his kids be just fine if he passes away prematurely? Believe it or not, the ultra wealthy do indeed buy astronomical amounts of life insurance. But it's not the billionaires who buy the most. The biggest buyers are banks and large corporations, from Walmart to Wells Fargo. And he says what they really want is a place to park their cash in an IRS-sanctioned vehicle that allows them to grow their investments tax-free. And he says also, if it's good enough for billionaires and the world's largest corporations, it's probably good enough for us. And then the reasons he lists for why they would want to be using this vehicle and saving into whole life insurance or life insurance contracts is the fact that there are unlimited deposit amounts. So they're not restricted on how much, or nobody's restricted on how much you can fund into a policy each year. Now, as I've mentioned before in the past, there are some constraints that have to go along with your income and how much insurance. You at least have to have a minimum, which most people have no problem meeting. But there are very few little obstacles or constraints, but really almost nobody comes to that point. So you basically can fund at whatever amount you want, not restricted like in IRAs or 401ks, or some people who can't even do a Roth IRA because they make too much money. There's also no tax on the growth of your investments. And there's no tax when the funds are accessed if you structure it properly. And any money left over to your heirs cannot be taxed. And so this is what he is saying in his book, in this chapter, about what he calls the rich man's Roth. And so, wealthy people do take advantage of this strategy. I also haven't looked up recent stats, but a while back, there was a list of banks and how much of their tier one assets are in whole life insurance. I have an article that shares a few of these banks. This article is from back in 2009, written by Barry James Dyke, which I know I've shared before, is an excellent author who really digs deep for his information on everything. And back then he was pointing out how a lot of banks have a high percentage of their tier one capital in life insurance contracts. As an example, Wells Fargo had over 22% of their tier one capital in life insurance contracts. US Bancorp had over 30% in life insurance contracts, and KeyBank had almost 36% of its capital in its tier one assets in life insurance. So it's been no secret to these wealthy bankers, and also no secret to wealthy business owners who, again, do like to house money inside of whole life contracts. I know I've mentioned this before, but there's Walt Disney, who borrowed $100,000 against his life insurance policy to fund and open Disneyland. There's JCPenney, who saved his company during the Great Depression by borrowing against his life insurance policies to help pay his employees and keep his company going. There's also Ray Kroc, the founder of McDonald's, who borrowed against his life insurance policies to get McDonald's up and going, their branding, and to pay his key employees. As well as another business owner example would be Doris Christopher, the founder of Pampered Chef. She borrowed against her life insurance policy to create her business. I'm sure most of you have heard of the Pampered Chef or have some of her products in your kitchen. I know I certainly do. So, certainly lots of wealthy, very wealthy people have practiced infinite banking, whether they were aware of that term or not. But that doesn't mean it's only for the wealthy. While high income individuals may find it easier to allocate funds for whole life insurance premiums, this strategy can and does benefit people across various income levels. The key lies in requiring a policy that's tailored to your budget and your goals. Now, I've worked with and talked with some agents over the years who would say things like, if the client doesn't have at least $5,000 to put into a policy, then it's not worth it. And for that agent, what they're really saying is that it wasn't worth it to the agent to help the client. Why? Well, because the pay would be too low for the agent and makes it feel not worthwhile to go through the process of teaching someone and helping them. But for the person who can only afford 5,000 a year or something like that, a very small policy in general, a policy can still be a true blessing in your life because over time, that money adds up. In addition to the premiums being paid in, the guaranteed crediting rate is also being applied to the policy, and that guaranteed rate is also being applied to the dividends that you're earning year after year in your contract. So your account is like a snowball. It starts off with your premiums and doesn't seem like much, but as it rolls down the hill of life, it collects, or in this case, earns on itself and gets larger and larger. And while it's collecting snow and growing as it rolls, more snow is being added to your metaphorical snowball in the form of premiums and dividends. And the longer your snowball is able to roll through the snow, the larger it becomes. And as I mentioned, you're adding to it in the form of premiums and dividends, and also the guaranteed crediting rate that's being added in as well. Now, you may be a person whose cash flow is tighter than you would like it to be. You're thinking you will have to wait to start your banking system until your cash flow is more freed up, until your debts are paid off, or until you're earning more money. But I would just encourage you to start where you're at because time will so easily get away from you. And even if you're only able to start funding a whole life policy at a fraction of what you would hope to, starting sooner than later will always be best. I always encourage clients to begin as soon as possible with the top end of their budget in mind because it is very easy to lower the premium, but you basically cannot increase your premium payments into an existing policy without causing it to mech. Now, there may be a little wiggle room and maybe possible to add a little bit more, but I would really touch base with your advisor before you go throwing in extra dollars to your contract, even if the company allows it because it could cause a mech. Whenever somebody asks me that question, I always check with the company to make sure that's not going to be an issue before we throw any additional funds in. Otherwise, you're basically keeping it to what was illustrated initially. That higher number is your mech ceiling in general. For me, I've started policies whenever I've had the resources to do so, and if I couldn't fit those resources into any of my existing policies. And sometimes I would think, I wonder if this will be easy to fund at this level next year, knowing that if my cash flow wouldn't be as lucrative the next year, well, you know what? That's no problem because my paid up additions are flexible. I can fund my full paid up additions, some lower amount, or skip the year altogether. But I would rather have the option to fund at the higher level and start the policy at the higher level sooner so that as many of my dollars are earning interest for as many years as possible. And if it turns out that I'm unable to save as much into my system next year or 3 years from now for some reason, well, that's okay because I can easily lower what I'm putting into my contract. I've talked to many people over the years who say, well, I just want to try it out. I'm just going to start with this smaller amount. I just want to test the waters. And then later, once I understand it much more fully, or once I see how it all works, then I will plan to start a second policy and fund at a higher level. Well, by doing that, just think of all the dollars that will slip through your fingers over those years before you start that second policy. And maybe you won't even remember, and it will take you an extra year because you forgot you wanted to do that. All those dollars that you have handed over to someone else and will never earn on again. You may not see much of a difference waiting to fully fund in the way you believe you can today in the beginning years, but once it's been a couple of decades, you will see what that waiting has lost you, what that waiting has cost you. Usually, that's thousands of dollars, sometimes tens of thousands of dollars. So I would say connect with an IBC practitioner that you trust, read Becoming Your Own Banker by Nelson Nash, learn from a great teacher, and begin with whatever it is that you're able to do. You don't have to be wealthy to get started. You just have to start. Start locking in the earning power of as many of your dollars as you can with an amount that makes sense for you and for your budget. Makes me sad whenever I'm talking to someone and they decide they need to test the waters first. But of course, I'm happy to help them wherever they feel comfortable. But I just know that what that delay will cost. So I always feel like, oh man, you didn't learn deeply enough. Maybe I didn't get something through to you. I didn't teach you well enough, because they don't see what that delay will cost. But I mean, I'll say it again. Just start where you're at. Doesn't really matter. Even if you're one of those people who feels they need to test the waters, you're at least still going to have something growing for you and locking in that earning power on some of your dollars rather than none of your dollars. So if you're someone who is just starting to learn about the infinite banking concept, or someone who has been studying this concept for years and have been on the fence, don't worry about the state of your financial affairs before reaching out for help. Don't sit there saying to yourself, once I get this or that paid off, once I get that promotion, or once I'm in a better situation, I'll get started with this. Because there's a very large chance that we could help you get out of that difficult financial situation, to start taking control of your finances and your financial future, to help you capture the earning power of as many of your dollars before you spend them to pay off debts, and before you lose that earning power forever. As always, if you would like to partner with me, if you would like my help, you are welcome to reach out to me at Valerie@alphaomegawealth.com. Thank you so much for listening, and have a great week.